Welcome back to our Reconciliation Bill webinar, the One Big Beautiful Bill Act that was recently signed into law earlier this month. I'm here with Kyle Briner, and today we're going to be specifically kind of highlighting some of the business changes and getting into some more of the tax updates and changes that were a part of this reconciliation bill. Kyle, if you don't mind, just kind of introduce yourself, what you do here at the firm, and then we'll jump right in.
Yeah, thanks, Matthew. So I've been here for 9 years, primarily working in our tax department, a lot with businesses, high net worth individuals, kind of ranging in different industries from hospitality to construction, real estate investors. That's what I really enjoy doing. And a lot of what we might talk about today has some of those industries in particular that are going to be highly impacted by the new bill.
Of course. Let's kind of jump right in with qualified business income. I do feel like ever since the Tax Cut and Job Act of 2018, we might have been feeling like we've been trying to get our hands around this for the past 7 years. But with that being made permanent, what impacts in planning do you see for clients on a go-forward basis?
Yeah, so I'm a big fan of the 20% deduction. If someone makes $1 million a year, if they do not get that deduction, say that the QBI wasn't even in place, then they're missing out on tax savings of about $74,000. That's how big of an impact it is. So I really like it because we can actually plan to keep more income in the business, and then we can talk through how do we pay the owners or the investors via distribution guarantee payment to keep that income high, to get the most out of the deduction. But also the second thing I really like about it is it kind of does somewhat of a compliance check, because we can talk to our clients about, okay, if you are making this $1 million a year, whatever it might be, you need W-2 wages. And hey, do you have some independent contractors that should really be W-2 employees? So you get to check in and say, hey, are we doing the right reporting requirements, 1099 versus W-2, to make sure that they're in compliance there as well. So that's what I really like about the QBI.
Awesome. We've been in kind of a limbo phase with bonus depreciation, people trying to figure out what's going to happen there. With the new bill bringing back 100% bonus and some 179 adjustments, what are some of the high-level things that people need to be aware of now?
Yeah, so you've probably heard the expression, don't let the tax tail wag the dog. Mm-hmm. And so a lot of people, when they see the 100%, when they see 179 increase their limits, it's like, okay, let's run out and let's go search for all these tax savings. Well, it's like, let's make sure first that we have good cash flow to where it makes sense to make those expenditures, because I don't want to just put ourselves in a tough situation just to get that deduction. So if we've got cash flow, it's a great opportunity to, hey, if you need that asset, whatever it's a piece of equipment or a vehicle in that business, okay, it sweetens the pot a little bit. So, I love that for our taxpayers.
Awesome. Kind of similar with some capital expenditures. Let's get into the research and development and some of the developments there with this bill.
Mm-hmm. Yeah, so the R&D is really kind of a big component of this. In prior years, whenever the Tax Cuts and Jobs Act came in, we had to amortize all these expenses, which really killed a lot of manufacturing, things like that, because now we have to take that deduction over time. Well, now after 2024, we can go back to expensing those items, right? And there's actually some written language in the bill now to where there's certain exceptions where you can go back and amend prior tax returns to recoup and expense some of those items, or apply it going forward, like on a 1-2 year basis. So definitely get with your tax advisor when it comes to the R&D. In certain industries, especially with maybe it's restaurant or definitely manufacturing, retail, whatever it might be. Get with your tax advisor on that, because there could be some huge tax savings there.
Yeah, for sure. There's kind of a lot to chew on. What are some of the areas that you think are good planning areas for clients, that when you're meeting with clients, are going to be meeting with clients throughout the fall and into the winter? What are some areas that you think are special that should be talked about?
Yeah, that's a good question. So it really depends on the industry. We work with a bunch of different industries here. Like I mentioned earlier, I'm really kind of in that the hotel, construction, developer, real estate investor. There's a lot of that in Chattanooga and surrounding areas and states. And so, like for manufacturing, definitely get into the R&D, be asking those questions, and also looking at the qualified production property. It's like all of a sudden, after July 4th, if you place a property in service, we get to expense it all if it's 39-year property, which is insane. When I first read that, I'm like, this can't be. Construction, definitely our contractors love to purchase, the assets like equipment, tools, vehicles, because they have to have it every single day, and that stuff wears out pretty quickly. But also, one thing in the bill that may not be getting a ton of attention is, they're required to be on a percentage of completion method for residential contracts. Anything that's got over 4 dwelling units. So, think about big condos, dorms, apartment complexes. Well, now they can actually use an exempt method like a completed contract method and defer income on those contracts. So hopefully whoever has a tax advisor, they have someone that knows construction that can look at the different contracts that they have to make sure you get the full amount of that deferral. And that also helps with AMT, which is usually a big kicker. So big things there. Real estate investor in the hotels industry, obviously the 100% bonus depreciation makes the cost segs, very attractive. And, some of the new language with the opportunity zones, the indefinite deferrals, and with the qualified rural opportunity funds, which is a really interesting new component. So, like I said earlier, it really just depends on the type of industry that you're in. But there's a lot of really big things in there that's going to take a while to unpack.
Yes, for sure. Thank you guys for joining us today. We have more information on our website at hhmcpas.com/resources. We have a portal specifically dedicated to this reconciliation bill that can dive in on more information, and you can also reach out to your accountant or reach out to our firm, and we'd be happy to help answer any questions that you may have. Thank you. Thank you guys.